This is Ask the Compound. I am Ben Carlson. On today's show, is it time to lock in 5% yields yet? We'll be answering that question and more. Stick around. Welcome back to Ask the Compound. Welcome to everyone in the live chat on YouTube. Those watching via Twitter, which is still relatively new to us. Anyone in the live chat have a question for us, fire away. That's my New Year's resolution this year, to take more from the live chat. We love all the people that are there every week dutifully. On today's show, we will be answering questions straight from you, the viewer, about how to give financial advice to your parents when they turn into day traders, listening to people on YouTube. What's the best way to lock in higher bond yields, bond funds, individual bonds? We get that question a lot. How to reduce the cost of your auto insurance. How many years worth of spending you should keep in safe assets, and then how to start the process of drafting your will. We get a lot of parents who ask that question as of late. Remember, if you have a question for us here, email askthecompoundshow@gmail.com. Today's show is sponsored by our friends at Public. Go to public.com/ATC, where you can invest in just about anything: stocks, options, bonds, crypto. On today's show, we're answering a question about locking in higher yields. In Public's bond account, you can lock in yields of 6% or higher on corporate bonds. Those are individual bonds, not bond funds. You can fund your account in less than 5 minutes at public.com/ATC. That's public.com/ATC to learn more. Paid for by Public Investing. Full disclosures in the podcast description.
All right. So Dave in the chat says, what's up with that shirt? I'm assuming he's talking about your shirt.
I got a sweater on, Duncan. He's probably talking about you. I don't know. My sweater game is strong,
boring,
so I'm not...
Boring shirt. I don't know. Yours is pretty fancy looking. Is that marine layer?
I don't know.
I think it is. That's always a safe guess. I like it.
That's possible. What's my fit?
But yeah, elaborate, Dave. I don't know what you mean by what's up with that shirt.
Thanks, Dave. All right, let's get to a question.
Okay. Up first today, we have a question from Alex. My father has no experience in financial markets and had minimal exposure to the stock market before retiring. Unfortunately, since his retirement, his main hobby has become the stock market. He has spiraled into a YouTube rabbit hole of day traders who speak in absolute certainties. The consequences are that he seriously thinks that he can beat and time the market. He treats these YouTube videos as gospel. I asked him recently to compare his gains this year to the 25% increase in the S&P 500 last year, and he changed the subject. He still thinks he can beat the market. Do you have any advice for him or me?
Okay, I don't appreciate the slander coming from the chat right now about that I look at the Hamburglar. Can't win them all. Thanks, everyone. All right. There are two groups that are the hardest to give financial advice to, and it's the people who know way too much and think they have everything figured out, and the people who are novices and don't know anything yet and just learn a little bit. And it's almost like the opposite of that midwit meme, like the person in the middle thinks they're so smart, but it's people on the ends that are, it's the opposite of that, because both groups tend to be very overconfident in their abilities. Like the really intelligent and knowledgeable people, they get overconfident because they almost pay too much attention to what's going on in the markets, right? They assume they're smarter than the market. You get this a lot, unfortunately, not to slander any professions, but doctors, lawyers, engineers, these are very smart people, very educated. They assume that intelligence automatically translates into the market. Often those times those people are bad investors. And then the novice investor who starts learning and gets a little bit and takes the opinions of people who sound smart as gospel, that gets you in trouble too. Alex's dad is obviously in the second camp here, since he didn't have much experience, and now has all the time in the world in his hands, so he's gone down the YouTube rabbit hole. And I know exactly what kind of videos he's talking about. The people who, they probably have some fire in their backgrounds, or they're these people who talk really intelligently and they tell you they know exactly what's going to happen. A crash is coming, or we're going to the moon, or you need to buy this, or you need to get out of that. And it wasn't YouTube.
They're the people with Home Alone face thumbnails.
Yeah, and the people who speak with certainty, like, especially when you're first starting out, that seems intelligent. I didn't have the YouTube rabbit holes to fall down when I first started, but I became enamored with all the smart people I was coming in contact with in my job. And the people who I became enamored with were the ones who sounded the most sure and confident about their opinions. And it just made them sound so smart and believable. That's way easier to latch onto than someone who says, well, this could happen or this could happen. We'll see. I don't really know. That doesn't really give you a lot of confidence. And it really took the great financial crisis to show me how full of crap these people were, right? It's like, oh, they didn't know either. They didn't know anything. These people just pretended like they knew. It took me that comeuppance to realize it. And unfortunately, your dad is probably going to have to learn the hard way. I hate to put it that way, but the problem is you usually pay your tuition to the market gods when you're young and you don't have a lot of money in the markets, and that's fine. You take your lumps, you learn your mistakes, you learn from those past mistakes, and you move on. So I can see why he's so concerned about his father, the fact that he's retired. I'm sure he would have preferred that his dad took up golfing or pickleball or something as opposed to day trading videos on YouTube. I think my only advice to like contain the damage is to just try to talk him into carving out a smaller piece. Obviously, the dad knows his performance is probably not very good. If you ask him about it and he changes the subject, not usually a good sign. So I don't know. Try to get him down to 10, 15, 20% of his portfolio. If he wants to take the YouTube day trader advice and have it and go nuts, fine. And then tell him you want to start tracking his performance, see if it's worth it, right? He probably won't want to because I'm sure he knows. But if he wants to do it because he finds it entertaining and it's part of his retirement, fine. I think you'd probably rather have him doing something else and not paying attention to his finances in retirement and enjoying life elsewhere. He might not listen to you, but I think it's worth going over the risks with him at least so he's not day trading away his retirement fund.
Yeah, the question I always have with these YouTubers who, because I've watched some of their content before, sometimes it's interesting or the people are charismatic and it's fun to watch. But the thing I always wonder is, why aren't they a billionaire? If they know all the trades to make and they're such a great, brilliant trader, why aren't they billionaires? I mean, right? They would be.
That's true. Yeah, I mean,
So
you get that
they're
from a
not.
lot of, and that's not to say like people with newsletters and people who have these different strategies can't be decent investors. But most time, if they pretend like they're like all knowing, all seeing, I know exactly what's going to happen. You're right. Those people probably should be more successful investors, and they should be running a hedge fund as opposed to telling you what to do on YouTube.
Right. And this is a good time to mention that nothing you see on YouTube should ever be considered financial advice. No one on
that's why
YouTube
we're here to
knows who
provide
you
context,
are.
not-
Yeah, your circumstances. This is all, this is broad, general information. Nothing on YouTube should ever be considered specific financial advice.
Yeah, Flynn in the chat says, "Show me the gain. Don't show me the gains. Show me the losses." And then that's true, especially when the market has been doing so well. If you can't keep up now, I don't know when you're ever going to.
Right.
All right, another question.
Okay, up next we have one that came in from Twitter or X. Save a 10-year...
No, we don't call it X here. Sorry, I'm not big on name changes, even though we did change the name of the show once.
I mean, a certain period of time is going to go by and there's going to be people who don't remember Twitter. They're just going to know X. They're not going to know what you're talking about.
Twitter. Yeah, sorry. It's always going to be Twitter to me.
Okay. Okay, so one from Twitter. Save a 10-year got to 5% and you wanted to allocate some of the 40 side there. Wouldn't you be better off buying the bonds straight up as opposed to an ETF like IEF? The ETF is no guarantee of principal return, right?
So,
IEF is like a medium.
It's an ETF, so it's 7 to 10 year
7-10.
Treasury fund. Daniel, give me a chart on here. I got the 10-year. This is as of yesterday, maybe this morning, as of like 4.57. So we'll run it up to 4.6. So we're closing in on 5%. Not terrible, but we're getting there. Next chart, Daniel. This is the 10-year this decade alone. And we've gone from a low of 50 basis points, so that's 0.5% to non-finance people. And then we went all the way up to nearly 5% in the fall of 2023. And then we kind of have gone back and forth and get back there. So we've been all over the place in terms of yields. So it's understandable why people these days are thinking about like locking stuff in, because anyone who remembers how paltry the yields were in the 2010s and early parts of the 2020s understands this. So this is also one of my favorite topics that I have to cover once every couple of years. This question is asking about the individual bonds versus bond funds. And my take is one option isn't better or worse than the others. A bond ETF is simply a fund made up of individual bonds. So it can't be that much different. The difference is holding an individual bond to maturity doesn't make it any less risky than a bond fund. You're still subject to changes in market rates, whether you acknowledge it or not, right? A lot of people assume this was a hack against rising rates and rising in inflation, right? Like, it wasn't, okay? By holding a bond to maturity, you will indeed get your principal back at maturity and avoid those mark-to-market losses. But it'll happen in an environment with higher yields and higher inflation, meaning the nominal principal you receive is now worth less in the future. Plus, you were earning a lower than market yield after rates rose. So people in bond funds took their lumps and took the principal losses, but then they were able to earn higher yields sooner than people who held to maturity. So it's kind of like a pick your poison kind of thing. I'm not saying one's better or worse. They're just different, and it really depends on your goals. Okay, had to get that off my chest. Felt good. So it's like if you're locking in a 10-year bond, do you have spending goal in 10 years you want to hit? Is it 5 years so you could do a 5-year bond, or 7 years? I think you can think of it that way. If you're really worried about interest rate risk or reinvestment risk, you could do a bond ladder. So you buy a 1, 3, 5, 7, and 10-year bond, and then some of them come due over time, and then rates are going to be higher or lower when they come due, and then you either use that money for spending or you reinvest it in bonds and sort of keep that ladder however the duration of maturity you want. The ETF option gives you more of a static holding period. So when you hold an individual bond, if let's say you buy a 10-year bond today, in a year it's a 9-year bond. In another year it's an 8-year bond, and so on and so forth until it matures. Most bond funds seek a more constant maturity or duration. So that IEF that I mentioned in the question, that's the iShares 7 to 10-year Treasury ETF. Average yield to maturity right now is 4.5, 4.6%. Actually, Daniel, why don't you put it up here? I did a list of all these different ETFs just to show what the actual yield is on some of them. So I went from askgov.
Those ETFs sound pretty complex to run in the back end.
Yeah, that's why it's great to pay someone else to do it for you, right?
Yeah.
You pay pennies on the dollar to do it. So askgov is like their T-bill yield. You can see it's fallen now. LQD is the corporate bond yield, and I did the AG, which is more of a total bond fund. IEF is the one in question here, 7 to 10. IEI, that's 3 to 5 year bonds. Then SHY is a 1 to 3 year. So you get your whole host of different bonds here. You can see they're all in the 4 to 6% range, so pretty darn good actually. There's also the U.S. benchmark series. They have the U10, which is exactly the 10-year. So it's not like a 7 to 10. You want to get strictly that 10-year yield. I mean, I don't know. Do you have to wait for yields to hit 10% to start locking them in? I think that might be getting a little too cute with it. Like maybe yields keep rising, but I don't know if you want to like start playing that game. I think it's pretty close enough. The AG, as I said, if you have any sort of total bond market index fund, you're already pretty close to 5%. Corporate bond funds, again, are 5.5%, 6%-ish. High yields higher than that, although that comes with more equity risk. So these funds have a different makeup of bonds than just a treasury fund, but that's why you get the higher yields. As always, the best timing for these decisions is no one knows. But I think there are far more exciting investments out there right now, and people see stuff going crazy. But there is going to come a point in time where people are kicking themselves for not locking in these 5% yields. And I feel very strongly about that, however you choose to do it. And again, a lot of it depends on what your goals are and what you're trying to get out of it between owning some individual bonds or owning a bond fund. So I think that kind of can color how you think about this. You could also diversify your bond funds and own some different maturities to kind of space out the risk.
So is it correct to say bond stuff always confuses me personally? It seemed like part of what they're asking is you put $1,000 into an actual bond that you buy, and you put $1,000 into a bond fund, an ETF. The bond itself, you are guaranteed to get your $1,000 back, right? Whereas you can lose the $1,000 in the ETF, right? Is that kind of what they're asking?
No,
that technically the ETF, you're not guaranteed to get your $1,000 back.
Well, you don't get it back at a certain date, but the bonds in those bond funds are constantly being recycled and traded, right? To keep some of those bonds in the bond funds are maturing, and they're taking that money and they're reinvesting it in other bonds that are longer term. And so you just have more bonds, but they're trying to keep a duration that is close enough to what you're asking for in the bond ETF. Okay. So it's like you're just seeing some more churn there. They're selling some bonds and they're having some bonds mature, but they're trying to keep the average of it close to that 7 to 10 years if that's the bond fund you're looking for. So you can have some price. Yeah, so if rates go down, your bond ETF is going to go up in price. You're going to see some returns be pulled forward. Whereas if you're holding the bond to maturity, your bond is going to be worth more, but if you don't sell it, then that means nothing to you, right? Okay. So it's kind of when do you want to see those returns?
Okay.
Right?
I see.
It's kind of depends on when you want to take them. So it's not a hack to simply hold an individual bond till maturity. It just changes when you get those returns.
I see. Okay. That makes sense.
But a lot of people do get confused by this. And there are some people who think it's like magical thinking to hold an individual bond to maturity, and it's not.
Right. Yeah. I can see why, but yeah, makes sense.
Next question.
Okay. Up next, we have a question from Alexander. One of the things that has been driving me crazy is insurance inflation. I want to remove a portion of it from our family's finances. We have a large bonus coming up, and I want to use a portion of it to reduce our auto insurance. Assuming our 2 cars are worth $50,000 total, we'd invest that amount to cover our comp/collision, covering your own car, not liability where you cover what you hit, and cancel that portion of our coverage. I would put it into something like BIL. Is it that simple?
The BIL is the T-bill ETF. I've written about the insurance crisis a few times over the past year or so. I wrote this blog post called "Is Auto Insurance Becoming a Crisis?" A lot of people like reading this stuff because it impacts so many people. Let's recount the reasons why these auto insurance rates are going up so much higher. Higher vehicle prices because of inflation, and we had such a supply crunch and the COVID. Higher maintenance costs. You pay higher wages, higher parts costs. There's the sensors and the cameras and all this better technology in these cars. It costs a lot more to fix them these days, and that's only going to get worse as self-driving stuff. Like every time you wreck your car, it's going to cost so much more. Drivers got worse in the pandemic. There are actually studies about this, that people were driving faster because there was less traffic on the road.
Oh, I've noticed.
And more reckless. And then now that more people are back on the road, they kept driving like that. So that's actually a real thing. Climate change, all these cars got wrecked in like hurricanes and stuff and wildfires, and that increases the cost. And then there's also litigation costs, where there are certain states where it's easier to sue these insurance companies, and that's increasing the cost. Daniel, give me a chart on this. Is motor vehicle insurance CPI going back the past 10 years. So over the past 10 years, it's essentially doubled. It's up 60% since the start of 2021 alone for vehicle insurance. So this is no joke. I can understand why people are annoyed at having to pay so much in insurance, but I'm not sure setting aside 50 grand is the right way to do this. I feel like you're just trading one opportunity cost for another. So let's say you get rid of that collision coverage. How much are you actually saving on a monthly basis? And then what's your break even for that money that you're holding? I don't know if it's actually worth it. I kind of tried to play a little bit with my deductibles on mine today, and I don't know. What do you save? A few $100 a month at the most or something? I don't know. So I can see increasing your deductibles to lower that monthly cost while also keeping some money as a backstop. But I think the opportunity of just keeping 50 grand lying around that completely covers your car. I don't know. Why don't you just get rid of the insurance altogether in that case or something? So I think this move just seems a little extreme and excessive. I think if you want to increase your deductibles across the board and put your monthly savings away in cash, that seems like it's a reasonable outcome to me. But I don't think that you have to necessarily put 50 grand and cover the whole car. That seems like very risk averse to me. I'm sure if anyone in the chat has actually dropped their coverage. I've also shopped around a lot in the past 2 or 3 years for auto insurance. I got a 20% jacked up rate from my insurer. I shopped around. I think I got it 10% lower, and I've changed once or twice, and it actually worked. This year when I reviewed my rate, it actually went down a little bit. So Chris in the chat says they dropped collision on their beater.
You negotiated down, or you switched insurance
I switched, and then when the renewal came in, it was actually down. Chris in the chat says they dropped collision on their beater. That makes sense to me. If you have a beater car it's probably going to be gone anyway, what's the point of keeping that insured? But I'm not sure you need to keep the full cost of your nicer vehicle sitting in cash. The opportunity cost there just seems way too big to me. And maybe if you want to just, again, jack up your deductibles and save the difference, that makes more sense to me.
Yeah. Sean says in the chat too, headlights are brighter. That's something that, it's really become a problem. It's so hard to drive at night. Headlights with LED and, the average lumens of headlights now, they're so bright.
Who made this decision? Really I don't like it either. It's horrible. It's
good if you're driving out on a country road at night and no one's around, but you can see a lot farther. But yeah, it makes it miserable for other people on the
I like the fact that cars now have like the automatic brights that go on and off for you. That's great, but they don't need to be so bright all the time. Yeah.
Exactly. Yeah.
I agree. All
it's
right.
rough.
Another question.
Okay. Up next, we have a question from James. How many years of spending should one have in bonds and cash? Is there anything about the current environment that affects this answer?
All right. This is one that feels like an investment portfolio management related question, but this is actually a financial planning question. So let's bring on a financial advisor to help out. Mr. Nick Sapienza. Financial advisor extraordinaire at Ritholtz Wealth Management, based in the Bayou in Louisiana, where they got the first snow in 500 years, I think.
Yeah, 10 inches.
Really, 10 inches? Okay, you got more than we did in Michigan.
Yeah.
All right, Nick, there are obviously a lot of circumstantial questions related here one needs to ask when determining this, but how do you handle this when working with clients, when thinking through, and I think this is especially true with people who are retired, maybe more so than anyone else, is figuring through, like, how safe should I get when I'm looking at my fixed income side of the equation or my cash liquidity side of the equation? Like, how do you go through this process?
Most common question with anyone that's nearing retirement or in retirement, to your point, is like, should I have a more conservative portfolio as I enter retirement? And maybe not. Maybe you just need to be more diversified from that standpoint. Like, you don't necessarily need to shift from a 70-30 to a 60-40, but you could, right? But the other side is, or maybe we can answer this from a different angle. When people come to you, Ben, and they say, I've got this cash set aside, it's in savings, it's not really doing much, right? Where should I put it? How should I invest it? The first two things that you're going to say are, well, what is your time horizon and what's your goal? And if the time horizon is like 2 years, you're going to say, okay, well, money market funds, T-bills, just leave it alone. Don't put any of that money in the stocks. But what is your line in the sand in terms of how many years your time horizon should be if you're going to start investing in stocks? Like some people say 5, some people say 7, some say 10. What's yours?
Yeah, I think 5 is a pretty good starting point, 5 to 7. And I like to keep that same thing with like owning a house too, right? Like don't sell a house you buy if you're not going to be willing to hold it for 5 to 7 years. But I think that's a good starting point.
Yeah. So if we can pull up this chart, investing for the long term, this is a breakdown of the S&P 500's returns over various periods from 1871 to 2024. You've got everything from 1 month being basically a coin flip to 20 and 30 years being almost a guarantee, right? That you're going to have a positive return. What this chart doesn't tell you though is it just says positive returns, right? We didn't measure for anything above, like a 3% rate of return or anything like that. So
there's no guarantee what the return's going to be.
It could be 0.5% per year.
Wildly.
Right. It could be 0.5% per year. And not that anyone's like putting all their money, well, I'm sure plenty of people are putting all their money to the S&P, but this is maybe one of the reasons against that. But anyway, if we look at a 5-year period, there's an 89%, or historically it's been 89% of the time that you've received a positive return over that time period. So that's kind of the sweet spot for me. It's somewhere around 5 years. And it could be more based on that person's risk tolerance, but this is kind of speaking to risk capacity. Risk tolerance is the range of outcomes that I'm prepared to accept as an investor. It's more of a qualitative measure. It can change if I didn't have a good night's sleep or anything like that. Risk capacity is the range of outcomes or the amount of volatility that my portfolio can support while sustaining a certain level of withdrawals. But let's just say that we said, okay, 5 years is our line in the sand. Anything below 5 years, we're going to keep on the bonds and cash side of the equation. Now, taking that a step further to answer James's question, let's pull up this other cash flow chart if we can, this blue one. So on the top line, you see total outflows, and you see that this person is going to spend maybe, let's call it about $160,000 per year, and we're going to inflate that number every year by 2.5% to 3%. So we're accounting for all their spending needs with a buffer plus an inflation number. That person over that, if we're following this 5-year rule, that person is going to be spending about $861,000. I did the math ahead of time, don't worry. But $861,000 over that 5-year period. And they have a portfolio value, let's call it 3.2. So if you back that number in, then you get a portfolio that's going to be, really you can round up to, it's 27% in bonds, but let's round up to a 70-30. Then we can go back to this person. They might be 60, they might be 65, they might be 72 years old. And we say, okay, your risk capacity is, if you want to get like that scientific with it, the risk capacity is basically a 70-30 portfolio. Here's the historical rate of return, the historical range of outcomes. Is that a trade-off that feels comfortable to you? And then we can make that decision from there. But I think like that's the very least. Like if anything, we would increase the amount of bonds and cash. So this is basically how I would answer that question. And it mitigates a lot of things like a lackluster, prolonged period of flat returns.
I like the idea of setting a baseline like you do. And saying like our baseline here is this will cover you and you're in a 70-30. And then you figure out that's like you said, your capacity. Now what's your appetite for risk? Are you willing to do that? Or do you want to go a little more conservative in a 60-40 or a little more, all right, well, we're going to go do more of an 80-20 and that'll cover you. I think the other piece for retirees is like, how long do I have to wait it out in a bear market? Because that's the thing that you don't want to do is sell your stocks while they are down, right? And so I think that's the biggest worry from a lot of people is just how long is that bear market going to last? And can I outlast that thing? I think that's the bigger question for a lot of people.
And using more data, we've gotten a bear market about every 3.8 years to be exact. And the magnitude has been somewhere around 30%, maybe 28%. In a 70-30, you're going to get, well, if you're all in the S&P and no offset from bonds, it's about a 21% drawdown. And then, the average bear market might last 18 months. Which, I mean, I think has been shorter, but let's just say that historically it's been about 18 months. So you're covering all your bases there. And again, you can dial it up a little bit.
Duncan just went through a bear market really quick on a show here.
Yeah.
We lost him. No, that's great. And I think with all these questions, getting back to the YouTube person from the beginning, there's no certainty in these things. You can't say, listen, you need exactly 5 years worth of cash. But I think you have to come to a place where you're comfortable with it. And my way of thinking for people is always like, let's say you are spending 4 to 5% of your portfolio in retirement. Mm-hmm. If you have 30% in bonds today, how many dollars today are you covering? So that's 6 years of spending that you're covering if you have 30% in bonds or something like that. And I think that's a good way for people to frame this, to think like, oh, you're right, I could spend that down. Now the opposite side of that is, okay, let's say we do go in a 4-year bear market and you spend 4 years worth of fixed income. Now you have a much higher equity allocation if you're not rebalancing or something along the way. So that helps you think through those conversations and come to a good point where people can say, all right, I'm good.
Yeah, it's not going to be exact, and this person might be. It would be a different answer if he said, what amount of cash should I have on hand?" Because that might be personal preference. You could say anything from like 1/4's worth of cash to 2 years worth of cash, but it's going to be more of a qualitative decision. But at the very least, this is going to be an ongoing decision that this person is going to make, especially as stocks are doing better or worse. They might want to change that schematic. So at least they have a system in place where they can lean on and say, okay, I'm going to follow, call it the 5-year rule or whatever, but I'm going to follow that.
And then the first step you always take, obviously, is how much are you actually spending every year, right? And when you went through that and you showed how it grows by inflation, I think that can help people come to a better understanding of, okay, this is what my portfolio can actually handle without getting too crazy and taking too much out and then leaving you for that risk.
Yeah, exactly.
Good stuff. Thank you, Nick.
Of course.
Thanks, Nick.
We got one more question.
You got me, Ben?
You're here.
Okay, we'll see if it lasts. I don't know what's going on with my internet. Sorry about that. Okay, last but not least, we got a question from Matt. I was recently discussing wills with a friend, and we realized neither of us has one. We're both 35 years old, have W-2 jobs, a 401k, equity in our homes, and 2 to 3 kids. Our financial situations are fairly straightforward. We don't own small businesses or have any complex assets. I'm guessing there are many listeners in the same boat. Curious to hear your advice on obtaining a will for this type of structure. Is an online resource sufficient, or would you recommend working with an attorney?
We've actually gotten a handful of these questions lately. I do think it's funny that 2 friends were talking about having a will. They must be viewers of the show because that's a very nerdy conversation to have. But I'm here for it. So let's bring on our estate planning expert, Taylor Hollis.
Hey, Taylor.
Taylor, how many will conversations do you have a week?
A lot.
Okay.
I lose count. Yeah.
All right. I think this is obviously something that I think happens when you have a young family and you start thinking about, insurance needs and estate needs and the will and like what would actually happen to me. My wife always has these very really downer conversations before I get on a plane. Like, what happens if the plane goes down? I'm like, oh, thanks for mentioning that. But I mean, you can't just completely ignore these things. So you have to think about them. So like, what is the first step for a young person who, it sounds like, listen, not very complicated situation. They don't have a ton of extra things going on that are going to make it a weird, it's like, where do you even begin?
Yeah, I'm so glad he asked this question because I think, Ben, you just mentioned it. I think this is so common with this demographic because a lot of people think, well, things aren't complicated. Why do I need one? Or, most people, it just falls so far down the priority list. Not many people prioritize talking about, death and taxes. It's just not fun. So I'm glad this question was sent in. My biggest piece of advice is doing something is better than doing nothing. If you do nothing, if you pass away, right, with no documents, no legal wishes on paper, then everything is subject to the courts, which is
how much of a pain in the butt is that?
A lot,
okay.
a big one, and maybe we'll save the whole probate conversation for another one of these. But this type of simple situation, I think an online service would be fine, right? Like I said, totally better than nothing. If the hurdle of getting, calling an attorney, finding an attorney, calling them, going to their office, going through these conversations, right? Like it can easily keep getting pushed away. So set some time, sit down online and just hammer something out on one of these online services. Plus, we're in 25, like they're with, fintech, like there's some really good ones out there that can draft really, really good documents. So what I would tell,
right? That's what someone asked in the chat. Does Ben have a loan? He named guardians. That's another conversation that's just not fun to have. Like, where do our kids go if something happens to both of us?
Yeah.
Right? And these are the conversations that you're forced to have with this. And I think this is one of the reasons why people push this stuff out and don't want to do it because it's kind of
fun.
awkward. No, it's not very fun, but but it's necessary. And I did one of the online ones, and I'm sure at a certain point I'll have to get something a little more, as things get more complicated, I'll have to figure out something better. But I think that's a good starting point, right? So to your point, like do something as opposed to nothing. Having a bad plan is better than having no plan.
Exactly. And, people in this situation, I tell them the two biggest things you need to be prepared for, decisions you'll need to make are, Ben, you just mentioned it, who's going to take care of our kids, right? If we're both gone. And then, if you can think through how you want assets to pass to your heirs. And there's a lot that goes into that. And especially if you have young kids, like, we do, like, it's hard to think about, well, what are they going to be like when they're 18? It's hard to know, but just thinking about, what kinds of things are important to us, for them to continue. Like, do you always want them to go to summer camp? I mean, you can kind of get to those granular thoughts of how you want the resources to be used for their benefit. So those are my two biggest pieces of advice before you even sit down to do it. Kind of have those brainstorming conversations, and that'll make it a little easier when you sit down and actually knock it out.
The other thing people keep mentioning in the chat is just term life insurance is another pretty easy one. I think at that age, I think that's probably a pretty good starting point as well, just to have those bases covered. It's much cheaper than people realize. I know it seems like you're just throwing money away, but that in terms of having that, okay, everything's going to be okay in that scenario. I've had conversations with people that have unfortunately had this happen at a young age, middle age, that sort of thing. We get this all the time with clients, right? Where it's unfortunate, but having that as a backstop, the last thing you want to worry about in that instance is the finances.
Exactly.
Yeah. So, okay. So you think finding a simple online fintech is the first easy, so you have something that you can actually, all right, we've done something.
Yeah, start there, get it done. And then, best practice is to, review them yourself or have them reviewed every 5 to 7 years. A lot of people think that you need to update each time you have a child. Most documents are written such that they cover all future children too. So while that's not necessarily the case that you need to formally update it, it might be a good time to just reread it. And yeah, Ben, to your point, my guess is somewhere along the line, it will make sense for them to engage an attorney and have a human element to this, because obviously we're big believers in human advice, right? For more complex cases. So that day will likely come, but for now, online is better than nothing.
Okay, so I like the fact that knowledge that you can do it after child 1, you even to have child 2, 3, and 4 down the line, that it'll still be covered and you'll be okay. Right.
Most documents I've read, yes, cover future children. Yeah.
I have 3 kids because I like to diversify.
There you go.
All right. Very helpful. Again, it's funny how many of those you see. These life events are always what cause people to reach out and ask questions, right? It's I just had kids. What do I do now? How do I save for them? I'm going to retire. What do I do now? These are the kind of things people reach out to for financial advice.
Yeah.
Always and forever. All right. Appreciate your help, Taylor. We lost Duncan there a few times.
Probably going to lose me again, but we'll see.
Still alive. If Duncan drops off the chat one more time, I get his Oatly shares. That's an issue.
Oh, my God.
Remember, if you're watching this on YouTube, we also have a podcast version you can listen to if you want to. If you're listening on the podcast, come join us in the live chat on YouTube if you can. Subscribe to the Compound channel on the YouTube. Check out the Compound Insider at thecompoundnews.com. I'm just full of plugs today. Email us if you have a question. askthecompoundshow@gmail.com. We always appreciate your emails and your questions. We'll see you next time. Thank you, everyone.
See you, everyone.